A bad bank idea in the budget had been doing the rounds, but it was only after Mr. Uday Kotak said he expects the AIF route to bad bank that we thought we should explore more on this issue. AIF is alternate investment funds. They are funds which buy up big companies. Now, this idea of several bad banks, many funds coming in and buying stressed assets through the alternate investment route is something the budget may give a push from what we pick up from sources. This story actually begins with the Reserve Bank itself, which, separately, besides Mr. Uday Kotak, Mr. Anil Agarwal also told us that he is planning to raise $10 billion of a fund. He is being one of the investors, gets other big investors, and that fund will invest in stressed assets. So it's both Mr. Uday Kotak dropping the hint of AIFs and Anil Agarwal, which set us picking up the buzz on a different kind of bad bank. How will this work? Much before this, unconnected to the budget, the Reserve Bank had put out a consultative paper that will come up for you, had put out a consultative paper saying that, you should have, it was a paper on securitization. But basically what that paper said is banks should be allowed to sell stressed assets to any regulated entity. At the moment, they are only selling it to asset reconstruction companies, ARCs. They don't sell it to AIFs. So AIFs cannot buy directly a loan. They are regulated by SEBI, and SEBI is a securities regulator. So AIFs have to buy only securities. At the moment, what they do is the NPAs that they want, they request one of their ARCs to buy it, asset reconstruction companies. The asset reconstruction company buys it, issues security receipts on behalf of that asset, and that is sold to the AIF. So that's how the AIF comes into the stressed loan market. Now, the expectation was, unrelated to the budget, that the Reserve Bank may tweak its rules to allow banks to directly sell to AIFs. The SEBI, on the other hand, may rewrite its rules to say that AIFs will be allowed to buy loans and not just securities. Some such tweaking of rules was always expected. But where does the budget come into the picture? The budget is in the picture because there's a tax angle. Now, let us assume an AIF buys a 1 rupee asset for about 20 paise, and then they're able to turn it around and they sell it to another promoter at about, say, 50 paise. So 30 paise or 30% is their profit. If it is treated as income, then it gets a 40% tax in India. That would make it unviable. So what the AIFs want is that the budget make a statement that these will be treated as capital gains. If it's capital gains, it's much less, 10 or 20%. And therefore, that is one expectation. Through the AIF route, that the budget give a tax SOP. Separately, what is the traditional bad bank idea? The traditional bad bank is that it should be a public sector company. So the expectation under that frame of reference is that the government creates an SPV, a special purpose vehicle, or a body which is 100% owned by the government and capitalized by the government. This bad bank, this entity, assesses all the stressed assets in the banking system, gives a cutoff. Okay, I'm going to buy all the assets over 1,000 crore or whatever, 5,000 crore. It assesses the assets and says this one I'm going to buy at 30% the book value. This one I will buy for 40%, depending on their due diligence. Now, banks are told if you either sell it to them, sell it to the bad bank for the price they ask. If you are not selling it, to that extent, you have to make provision in your books. So this is an incentive for the banks to sell. Once the bad bank has all the assets, because it has collated it, it is able to bargain with funds and sell it, auction it to another promoter, to another fund for turning it around. So that is how the traditional bad bank is expected to work. Usually it doesn't require a lot of money because for the assets it buys, it may not even give money to the banks. It may give only receipts, IOUs, securities. And then when the asset is turned around, the value of the bank's securities go up and the banks encash it. That is the traditional bad bank idea. What we are given to understand from sources is that this traditional bad bank may not be something the government will attempt this time, but it may make it easier for alternate investment funds to come around and buy stressed assets, as Mr. Uday Kotak alluded.